The second part of tonight is financial projections, and our presenter is Charlie Tillett. Charlie is a serial entrepreneur, chief financial officer, who's done all sorts of things, including taking a company with a few employees to IPO and beyond. When he was at MIT Sloan School of Management, he entered the 10K, I think it was at the time, and placed second for some crazy thing called an LCD projector. Among his many passions, he's a pilot and a heli-ski enthusiast. And the financial projections spreadsheet that he's going to show you tonight has been used by people all over the world. I was in Istanbul mentoring a team from Pakistan at an international entrepreneurship summit. And I looked at the projections and I said, I think I've seen this before. And it was Charlie's projection spreadsheet. And in fact, I used a version of it in the past year to present to some investors. So you're in good hands. And Charlie, please take it away.
Great. Let me share my screen here. Okay. Can everyone see that? Can anyone see it? Yes. Okay, good.
Yes.
So super. So our last presentation, I know Julianne said it was a lot of information in a short period of time. We've got even more information in just a slightly longer period of time. So so I will go kind of quick. Let's see if I can leave. Trying to look for chats to see if there's if I can see more chat. I'll leave the chat up here, and if questions come up, put them in there, and I'll try and glance over that and see what's going on. This presentation will be on the website, and I'm going to share with you two spreadsheets that will also be on the website. And we're going to, that's the real thing we're trying to get to today, is walk through those two spreadsheets, because those will be the tool, the foundation for when you build your financial plans. So let's see. Let's see if I do this. Okay, that's still good? So we're going to talk about your business plan, financials, and also the cash flow statement. And then if we have enough time, we'll talk a little bit about dividing up equity in your company, and in this little spreadsheet that I put together with that to help you think about it. So let's see, for some reason, there we go. So as Joe mentioned, my background, I've been involved in two companies. Well, I was third place in the 10K contest. I also spent the summer at a venture capital firm. It gave me a lot of insight into how venture capitalists think about investing. It was really beneficial when I was, for the rest of my career, when I was sitting on the other side of the table. I worked at the first company I joined out of Sloan. It was in the data communication space, and we bootstrapped the company to about $6 million in revenue before we took our first dime in venture capital. We raised $6 million on a $54 million pre-money and gave up 10% of the company. And then we did one other really big financing right before we went public. The next company I joined was in the aviation, it was bomb detection equipment for aviation checked luggage. And there it was a land grab situation. We had to raise money. The day we had our kickoff meeting, the CEO and I left and started working the phones. We raised an angel round of $1 million in about 60 days, maybe 90 days. We closed a VC round within 6 months of $5 million with a follow-on $5 million commitment. And as Julianne said, there's no one right answer, but I will tell you this: when NetScout Systems went public, the CEO and his partner each had between 15 and 20% of the company, whereas Reveal Imaging the founder had between 5 and 10% of the company because we had taken on so much financing so early. So it's always better to wait, but sometimes you can't afford to wait because the opportunity will get away from you. And I'll try and stress that when we get to the equity side of things, because it's not how big a slice of pie you have, it's how big the slice is, right? So if the pie is really big, you can do pretty well with a small slice. So I don't know, normally we do this in person, and so I get a little audience participation. I'm sure you who are students are used to studying in bed. Sometimes you wake up like this. And I would ask people, what do you usually get out of studying in bed when you think about that? You know, if you're reading a case, what happens the next day? And usually someone will have the same experience that I'll have, is that they'll have thought about that case in their sleep, and they'll have new insight into it the next morning, even though, you know, they may have only gotten halfway through it before they went to sleep. I had a business school professor who asked us, the entire class, one afternoon. He said, as you start your homework tonight, spend 3 minutes and write down 5 or 6 goals that you'd like to accomplish by your 10th year reunion. And then that was on the Tuesday class. And on the Thursday class, he had us go home and write down 5 or 6 goals for our 25th year reunion, seal it, put it in an envelope, and try not to lose it for the next 10 or 15 years. So I actually did this, and I'm not showing all of my goals because I want you to think about your own goals, but I will tell you that you guys are helping me meet one of my long-term goals by being a mentor and an angel investor for small startups and entrepreneurs. Remember, this was before I'd even been involved with a startup, but I was already thinking ahead. And the amazing thing about this exercise was that I found that by my 10th year reunion, I had met almost all but one of my 10-year goals, and I'd actually already met several of my 25-year goals. I didn't know that until I got to the 25th reunion and opened this up, because I didn't really think about it. But my theory on it is this, is that in the words of Bill Gates, we overestimate what we can accomplish in a year, but we underestimate what we can accomplish in a decade. And this has a relevance to putting your financial projections together. So I want to urge you to be cautious in the first year about what you think you're going to accomplish, but then be aggressive in your 5 and 6 year plan, because it's a long enough period to accomplish a lot. And if you'll humor me, tonight after this meeting, spend no more than 5 minutes on this. Write down 5 or 6 goals for your 10th and 25th MIT reunion. Put it in an envelope and try not to lose it. And then contact me in 25 years and let me know how you did on your goals. Now, I know what some of you are thinking. Some of you are thinking, how am I going to find Charlie Tillett? Yeah, I'll be on the Infinite Connection. There'll be plenty of ways to contact people in 25 years. The rest of you are thinking if I'm going to be around or not, but I looked at the IRS tables and I should make it to your 25th reunion. So why are you here tonight? Okay. Some of you want to start a business. Some of you want to win the 100K contest. Some of you want to do both, right? So as you think about your role as CEO, let me just try and move this a little bit. There we go. What is your job? And again, I'd usually ask the audience for this. Here's some of the answers that we frequently get. It's develop the product. It's build a great team. It's find that first customer or that first group of customers. And those are all part of your job. But I would argue the number one job is to make sure that there's enough money in the bank account, because money is the oxygen for your enterprise. And if you don't have cash in the bank to pay your employees, pay your rent, to buy the components that you need to build your product, or the computers that your people need, all the rest of this is for naught. So as you think about your financial projections, it's also going to be important to think about your cash projections. So your financial plan, the spreadsheet that we're going to put together tonight, is a roadmap for you to figure out how much cash you need. So do I need to raise $1 million in my seed round? Or do I need $3 million? Or should I just go ahead and get, I can raise $2 million, but I'm going to need to raise another $2 million 6 months from now. So maybe we should just raise $5 million. So it helps you figure out how much cash you need. The other important use of it is that it's the vehicle that every investor is going to be asking you to see that will help you obtain that cash. So, and it's, Juliana mentioned a couple things about substantiating your business plan. I guess I would take a slightly different take on it because there's so many unknowns. But I think that it's important that you make your assumptions explicit, and we'll talk about what those assumptions might be, because people will look at that and say, yeah, these assumptions make sense to me, or not. And so you want to find people who have industry knowledge, who have done this before. The mentoring program is a great place. Walk in with your assumptions and say, based on this, we think that this is what this business model is going to look like. And people will say, yeah, but this assumption is way off. So plug in the accurate number there, and you're going to have to tweak. You're probably going to have to tweak something else to get to a business plan that looks viable. So as I said, it will help you understand the assumptions that you make and the key drivers of your business. A lot of times people will think, well, if we increased our sales price, that might do it. Or if we decreased our marketing cost, that might be what really helps take this to the next level. So by plugging those numbers into your plan, you can determine what are the key levers there. What I found is that if you've got a great gross margin to begin with, say 75 or 80%, that's the last thing that you need to worry about, because getting an extra 5% of gross margin, that's great 3, 4, 5 years down the line. But if you've already got a great gross margin, now you need to start looking at those expenses below that gross margin line. This is the timeline from Reveal Imaging. I could spend an hour just walking you through every one of these funding steps that we took. As I mentioned, we started the company in Q4, and by Q1 we'd done our million angel round, and then by Q3 we did our first tranche of venture money. What I would tell you is that every financing requires negotiation, and it's almost the same level of negotiation, whether it's a $500,000 equipment line or a $5 million venture financing line. The person who has the money wants to protect their money, wants to be assured that they're going to get their money back with a fair return, and so everyone negotiates pretty hard when it comes to putting up money. What I would say here is notice that every 6 months we did some kind of financing round, and sometimes more than every 6 months. So I was always thinking about the next round of financing, at least as soon as we closed a round of financing, and often before we closed around that round of financing. So as soon as we were closing our Series A2, I'd already queued up the venture debt guys so that as soon as that money hit our bank account, I called them up and said, "We just closed our A2. Let's get our venture debt round in." And we needed that money to take us to the next level. So here's what we're trying to get to. We're trying to get to an income statement, which is also, and for the MBAs in the audience, bear with me. I have to assume everyone is starting from a slightly different place here. So I'm trying to get everyone kind of level set and understand what we're trying to get done here. So let me just walk you through the income statement. The top line is the sales line, also called the revenue. In this case, $50 million, right? And that would be after any discount. So if someone buys $1 million worth of product and they're entitled to a 10% discount, that's $9 million worth of revenue, not $10 million worth of revenue. Notice I don't have any line in here for discounts, okay? So this is the number that goes on the invoice out the door. Cost of goods sold is what it costs you to develop that product. If it's a hardware product, it would be all the components that go into it. It would be the labor cost to put it together, to load the software up. And it would also be any support costs. So if people get 6 months of free support, I just got a new iPad, I get some free support with that. The person that I call that answers my questions for that first 3 months is a cost of goods sold. So you think a company like Microsoft, where they're selling just software and it's all downloaded now, they don't even have to ship out DVDs, you think that they would have a 99% gross margin. The reality is their gross margin is about 85%. Well, we'll look at that in a second. So you subtract the cost of goods sold, that gives you your gross margin. In this case, it was $30 million or 60%. Simple math to get here. I will tell you, I've worked in companies that have an 80% gross margin and companies that have a 50% gross margin. It's a lot easier to make money, and you have a lot more flexibility about the things that you can do, especially in the sales and marketing area, when you have an 80% gross margin. So anything under 50% is going to be a challenge to have a profitable business, because you've really got to scale up to get profitable at a 50% gross margin. But sometimes you can't help it, right? Sales and marketing would kind of self-explanatory. Your sales staff, your marketing staff, any trade shows, any marketing literature. R&D is your programming staff, your technical staff, all of your engineers. And this is where, when you're developing your product, this is where kind of the lion's share of most technology companies spend their money, at least in the early days, and then transition to spending more money on sales and marketing. General and administration would be your CEO, your CFO. It would be your, I don't like to get your finances too complicated, so I would throw 100% of your rent in here. Your HR staff would be in here. If you have an internal IT staff, they would be in there as well. So you add those 3 departments up, that gives you your total expenses, and then subtract that from your gross margin. It gives you your operating profit, also referred to as your EBITDA, earnings before interest, taxes, depreciation, and amortization. And we'll talk a little bit about depreciation and amortization in a second. Let's see. So I guess the question was about Reveal's fundraising timeline. And the point that I was trying to drive home there is that because I had a financial model, I knew how long the money that we raised was going to last. And so I knew when we needed to raise more funding. Uh, uh, the typical VC process takes about 6 months. And that's if you don't have any stumbles along the way. It's hard to get it done less than 6 months. 5 would be, you'd be a rock star. 6 months, you're still a hero. And it often can take longer. So you really need to be looking, a year or at least a year, if not more, ahead to see when you're going to need money, to figure out when you need to start making those contacts with venture capitalists and queuing them up. So your income statement, I also like to refer to it as the business model, because once you get out to years 4 or 5, it really defines what this business looks like. It defines, is this a high gross margin business, or is a low gross margin business? I've already explained, you have to operate your business very differently depending on that. Reaching critical mass, it might be, depends on the company. It might be based on unit volume, where you get some economies of scale. It might be on geography. Let's say you're advertising, where you're doing advertising where if you have a lot of locations in one area, you can spread that cost over those locations. It could be on the number of transactions or the number of customers. So this business model, I'll explain why looking out in the later years is so critical, because it tells your business story and documents that you can make money, right? So let me go first. Let me spend a couple minutes on 2 ways not to project revenue. I see these all the time, okay? I don't know if anyone who's seen my presentation has actually then come back and tried to use this model, but I'm working with a company now. Literally, I just saw this last week. So the Chinese mitten model and the checkerboard model. So let's talk about the Chinese mitten model. As we know, there's 1.4 billion people in China, and they each have 2 hands, right? So therefore, the addressable market in China for mittens would be 2.8 billion mittens. And here's the key number that people throw in there. They say, well, if we could just get 1% market share, just think of that. We'd sell 28 million mittens, and at $5 a mitten, we'd have $140 million in revenue. I'm not saying that market share isn't a valuable piece of information, but it's a piece of information to validate that the bottom up projections that I'm going to get you to do are credible. But no one deserves any market share, whether it be 0.1%, 0.1% or 10%. You have to earn it, and I'll show you how to build those projections. The other model is kind of the checkerboard model, right? So I don't know if anyone's seen this before, but if you start with a penny on the first square of a checkerboard and you double it every square, so the second square you go to 2 pennies, the next square you go to 4 pennies, the ending value in square 64, no one ever guesses this number, but it's a lot, $92 quadrillion, okay? And so I hear what you're saying. You're going, wait a second, I'm going to use conservative numbers. We're only going to grow at 50% per square, right? And per square, so think of this as 50% per month, right? Well, if a growth rate of 50% per square, you only get to $1.2 billion. And so I'm not saying you can't. Let's say you're saying, well, I think we can grow 10% month over month. I'm not saying that that's not a valid target, but what you can't do is just use that as the justification for your growth. You need to show, I'm building the infrastructure to support 10% growth, and the 10% growth is the outcome. Now, maybe that means I need to put 10% more into sales and marketing every month, or I need to put 10% more into buying Google AdWords. It depends on your model. But you have to start at the bottom to justify the top, not the other way around. Okay, so how should you do it? Let's look at a couple of bottoms-up approaches here. So one would be, let's say you're selling a product. You have salespeople. They can make a certain number of sales calls. They're going to close a certain number of those sales calls. You have the average selling price. That gives you the sales per month per salesperson, sales per year per salesperson. Multiply that by your number of salespeople, and that gets you to revenue per year. So in this example, 20 sales calls yields 2 actual sales. Average selling price is $62,000, not for the product, but with the average order size is $62,000, right? It might be hardware, it might be software, it might be extended support, it might be some consulting for implementation. So with 2 sales a month, that means your salesperson is bringing in $125,000, $1.5 million per year. You bring in 5 salespeople, that gets you to $7.5 million. You explain those assumptions to someone, they may question them, but you can also justify how did you get to the 62,500? Here's what we think a customer is going to need. How can you close 2 sales? How can you make 20 sales calls? People, these are not unrealistic numbers. Okay, let's look at the, everyone wants to do app-based stuff. Let's look at the freemium model here. And so we'll walk through the numbers here, right? Let's say you get 100,000 visits to your website and 5% download the app. So you have 5,000 people who actually have the app on their phone. Only 20% of those actually use it. So you have 1,000 people who used your app. 10% of those paid to convert. So you have 100 people that actually paid, and at $5, that's $500. For the benefit of this example, let's say it's $5 per month, right? I don't know, maybe it's a valuable app instead of a one-time charge. So what does it cost you to get a visit to your website? Look, I'm not an internet guru, so I don't know. You've got to figure out what the right numbers for your business are. But here you go. Okay, if I could get this number of sales per month, that would be $6,000 worth of revenue on an annual basis, and it only cost me $1,000 to drive those customers there. I might have a viable business. But when you show these numbers to someone who understands the space and online marketing, they're going to have some questions about that. So that's why, again, talk to people who really know this space and build your funnel. And the last one would be the advertising model. So again, here you've got 100,000 visitors to your website a day, and you can sell advertising at cost per thousand. For the 100,000, that brings in $250. And then some of those people click through, and you can sell that at 75 cents. And so you get click-through revenue and you get CPM revenue. That's your total revenue per day. That brings you to $638,000 per year. You got to figure out, what do you have that gets 100,000 people to your site every day? The reality is, in my opinion, it is tough to run an advertising model, because how do you generate the traffic? I don't know if you guys are familiar with yoga with Adrienne. She's the most famous yoga teacher on the web. She has 5 million YouTube subscribers and earns $2.5 million a year. Now, for Adrienne, that's a great year. But if you're trying to grow a business, that's, it's a good business, but it's not the type of business that's going to get venture funding. And you got to figure out how you're going to get 5 million YouTube subscribers. So here's what we're trying to get to. Okay, we're trying to get. I only show 4 years. I think you should go out 5 years. It's usually a little hard to get to where you want to get to in 4 years, but I don't think you can go out more than 5 years. And I think you need to be at least reasonably profitable in starting in years 4 and 5. Because if you take longer than that to get to at least a little bit of profit, 5 or 10%, people are going to question where's the happy place in this business. And I know you could look at a lot of companies that have negative profits for decades. Okay, let's look at Amazon, Netflix, Tesla. Okay, but you're not Elon Musk, you're not Reed Hastings, and you're not Jeff Bezos. Okay, so those guys are kind of one of a kind, right? So for your plan, you've got to be more conservative and show some profitability. So here's what we're trying to get here. Here's when someone sends me a business plan, here's what I look at. The first thing I look at is the revenue. What type of business are they growing? Are they growing something from 250,000 to $1 million? I'm going to have a very different mindset about that business than someone who's trying to grow a business to 50 or 60 million dollars, right? The next thing that I look at is year 4 or year 5. What does this business model look like? What's the gross margin of this business? And once they get to year 4 or 5, where are they spending their money below the gross margin line? Is it big marketing expenses? Is it big? Is it still in R&D? So that's what I look at. And then, of course, we look at the profitability. Is this company able to get profitable in 4 or 5 years? Okay. The next thing that I look at is kind of the cumulative operating profit over that period of time. And what that does is it gives me a ballpark estimate of how much cash this business is going to need to get to profitability. So you say, okay, 4 million in year 1, 2 million in year 2, probably a little loss in Q1 and Q2 of year 3. So it looks like $6-7 million. Maybe they have to buy some CapEx for the engineering team. So under $10 million, it looks like it's a pretty good ratio of money that needs to be raised and where they hope to get to on the revenue and profitability side. So in these spreadsheets, the copy that you're going to get is color coded. Now, when you present this to other people, get rid of all the color coding, get rid of this column over here that says source. But if it's a blue number, as you notice, everything on this page is either blue or black. The blue numbers all are coming from another spreadsheet, and we're going to walk through those. The black numbers are calculated on this spreadsheet. So there's nothing to input on this spreadsheet. Red numbers are numbers that you input, and magenta numbers you'll see in the subsequent spreadsheets are those that are transferred to a higher level spreadsheet. So let's go through it. Profit and loss quarterly. So we're going to build your projections at the quarterly level. I know at some point you're going to have to do a monthly for at least year 1 and maybe year 2, but it's doing 4 years quarterly is already 16 columns, and there's a lot of numbers that get fat fingered in here, and there's I will tell you, the more columns you have, the more opportunity for errors to creep into your spreadsheet, busted formulas, whatever. So I recommend doing it until you get a model that you're happy with, and then use that year 1 model to create a 12-month plan that doesn't have to match up perfectly, but ballpark follows what you put into this plan. So if you notice in our quarterly, again, nothing is input here. All comes from your below spreadsheets. So where you're going to want to spend most of your time is on the revenue side, sales or revenue. So because calculating what you're going to spend below the gross margin line, I got to tell you, it's pretty easy. You put together a budget, you put together a hiring plan, you hire people, you kind of pay them what you thought you were going to pay them, you buy the stuff you thought you were going to buy, you pay the rent you expected to pay, and the expenses kind of take care of themselves. But if you don't have the gross margin there to cover those expenses, then you're starting to get into a world of hurt. So you're going to spend a lot of time here thinking about what is our business, what are we selling, what can we sell it for, how are we going to sell it. So here in the input side, I put, this is just, we've got a company, hardware company that's selling 3 models of product, and they sell 20 units in Q2, 50 in Q3, 100. And these numbers are all just fat fingered in. I'm not using a formula to say we're going to grow 10% a quarter or anything like that. Those are, and then here we have our cost, our sales price for the product. And notice that when we introduce Model 2, maybe it's faster, it's got some new features, we're worried that we're going to cannibalize Model 1, so we decrease the price there. Maybe that's a valid assumption, maybe it's not. It's something for you to think about for your business. So then our product revenue is really, it's black, so it's just a calculation. And our total revenue, or magenta, it's a calculation, but that goes over to the quarterly. I have also shown here support revenue, and it's the idea is that you would charge a 15% annual fee based on your installed base that continues to keep support. So in this example, I'm showing that 25% of your installed base does not renew their support, technical support each year, and that you charge 15%. So so this number here, the 7,500, is really just your installed base times 15% divided by 4, right? So this is an annual revenue, and this is a quarterly revenue. Okay. So here you add these two together, and that gives you your, I'm sorry, that gives you your, let's see, can I go back? And that gives you your total revenue. So let's see, cost of goods sold, sorry. So I show the unit sales on this spreadsheet just to help me think about what my cost of goods are likely to be based on volume. So I just bring this over here just as a reference point. It doesn't need to be here, and it's copied right from the prior worksheet. So, and also your installed supported base here. So here we have, we're building products. So we have a manufacturing staff, and here's the staffing plan. And then we have variable cost per unit, and you take the variable cost times the number of units, and it gives you your total variable cost. You add those up, there's your variable cost. You add your salaries and benefits in from your staffing plan, add your variable cost. You add in I added in a facilities charge. It's probably, I'm probably making it a little too complicated here. You could leave that off. And here's your total cost of goods sold, and that gets transferred to our quarterly financials. The second page you're going to spend the most time. So the first page you're going to spend the most time is your revenue page, thinking about how fast are we going to grow, and then getting all the numbers underneath that to support that. Likewise, your staffing plan needs to support that revenue plan. And so you're going to, if your expenses are too high, the first place to look is your staffing and reduce your staffing. If your expenses are too low, and that's frequently a problem, you need to add more staff. So So the question was, do I have this for a SaaS model? I have to tell you, I've had a yellow sticky on my desk for probably 2 years saying I should put this into a SaaS model, but I do not have one. So you're going to have to modify it. And where you would modify it is you're going to come up here with your sales plan. And in fact, you could use the support revenue here as part of a SaaS model, right? So we're getting sales. Maybe the sales aren't very lucrative, right? Because you're building your base, but your retention is going to be much better than 75%. And in fact, your support revenue will be 100% because they pay the same thing every month going forward. So that might be a way to modify that. Okay. The question was exact numbers, rounded numbers. You've got to, it's going to have to be exact numbers. Don't take it to 2 decimal, don't show decimal places, but you're plugging so many things in here, you can't, you're going to have to use real numbers. I mean, for me, as this example, I made everything nice and neat, but in reality, you'll see once we get to our salary expenses, these aren't, they aren't lining up quite as good. So here we have the first page of the first part of your staffing page plan is the head count. Notice these are all input, all red numbers here. So you have it by department, engineering, marketing. Down here, you've also got you've got G&A. You've also got G&A, right? And you've also got sales that get combined in expense with marketing, right? The next part of this is you've got your companion salary sheet, right? So here you have the same number of, this lines up exactly with your spreadsheet before. What I would urge you to do is don't go overboard with categories of people. Don't have senior programmer, junior programmer, have them all at different salaries. Just kind of glom it all together. Well, remember, all we're trying to do is get kind of a good estimate of where we're going to be. Now, when you actually put together your 12-month plan, that might be the place where you actually have specific jobs that you're going to hire and specific salaries. This salary for programmer is probably way out of date. This probably needs to be at least $100,000, if not more now. So all we're doing here is we're taking our chief technical officer salary, we're dividing it by 4, and we're multiplying it by the number of chief technical officers that we have, which is 1, right? So this is a quarter of 175, but we also have added in 15% to cover our payroll tax and our health insurance. And then you notice I also call this cost of living adjustment. So as we get into year 2, I start increasing that adjustment by 2% every quarter or 8% a year, because the reality is that people want pay raises, and you might as well build it into your plan. So this was my way of doing it. There's probably 10 different ways to do it. I think it's an elegant and simple way to just build it in, and that covers your health insurance and your benefits, that 15%, right? So all the other positions are the same way, but you may have multiple programmers, right? So notice here the program is only making 85,000, but the dollars are 97,000. Why? Because there's 2 or 3, and that number just keeps going up, right? So you could play around with the salaries and don't be shy about doing that, but where you really make your changes in this headcount, okay? So we take our salaries and benefits from the staffing plan, and then we need to add in some other expenses. So for engineers, they love tech supplies, they love gadgets, they need cables, they need oscilloscopes, you name it. In my experience, they spend about $2,000 PPPM per person per month. It sounds like a crazy amount sounds like $24,000 a year for across your whole engineering department. Believe me, they can find ways to spend it. they buy one oscilloscope for $30,000. That blows that person's budget for the whole year. And again, this is an average across the department. So we're just trying to put in some kind of number there. What I did here was I took a formula of $2,000 and multiplied it by the numbers on the staffing plan to come up with the 36,000. So the beauty of this is, if I think 2,000 is too much, I change it here to 1,000. All of these numbers change. As I change my staffing plan, all of these numbers change. So anywhere you can put in a formula, do it, because that's less fat fingering that you need to do. Marketing is probably going to be a lot of fat fingering. So you've got literature, you've got trade shows, you've got other. So all of these numbers are fat fingered in. In sales, again, travel per person per month, I put in 3,000. That's a pretty good number. Well, and once now everything's on Zoom, so you could, I wouldn't say eliminate it, but you could in a year. I did get my shot yesterday, so in a year, hopefully the world will be back to normal and salespeople will be traveling again. Other formulas in here is 3% as a percentage of revenue, is commissions. Again, I'm just trying to show you different formulas that you could put in for your business. So we've done all the spreadsheets below that, and now this just rolls up into the quarterly, and then the quarterly rolls up into the annual. Okay, and if you notice, the question was, do I use rounded numbers or not? Look at all these numbers. They're just, they are what they are, right? So when you're building your financial model, you're going to be flipping back to this page a lot. Okay, I don't know ways to keep two worksheets from an Excel spreadsheet open at the same time. I wish I knew, because it would be great to keep this page open as you change other pages. So the first thing you're going to look at when you finish your model is come back and look at this and say, is this too high? Is this too low? Is this look like a hockey stick? Should I really grow it more in a linear fashion? How do I like this? Can I justify this to an investor? Okay, if you don't have this right, don't make any other changes until you get this right, because all these other changes support the top line. So you could say, well, let me hire enough salespeople to support $66 million in sales. And then you go, nah, I want to be at $50 million in sales. Now you got to go back in and change all those salespeople. So this is where you start. The second place you start is look out here and say, do I like where this business has gotten to? Am I happy with these gross margins? Do they seem like they're appropriate for my business? Am I spending money in the right places below the gross margin line? Is my operating profit too high or too low? And so kind of this is, so you want to start modifying this to get you to the numbers here that you like. Then go back to year one, because I think year one, we can all sit here and go, okay, here's the first 10 people I would hire in my business. Here's what I think they're going to make. Here's how many offices we need at WeWork. Or maybe we can work out of, we can all work from home. Maybe we don't, does everyone need a computer? Here's what I'm going to spend in year one. You should be able, these numbers here, you should be able to figure out what you're going to spend in year one. Now, maybe you're just going to spend $1 million, right? You raise $1 million, spend $1 million. I don't think that these numbers here are what your business needs to look like. But you should be able to figure that out. Looking at year two, it's a little bit more of a stretch, but you say, is it double? Do I double all the people that we have? Some departments might want to more than double, especially sales and marketing if we have a product to sell. Maybe engineering, we've done all the hard work. We don't need to double engineering. Maybe we need to triple engineering? Those are questions for you to decide. And then look at your kind of your business model here in year 2, and what year 3 is just a transition year. So do whatever you need to do in year 3 to kind of get you from here at minus 16% to here at 24%, right? So your gross margin may or may not change in here. It depends on your business. Okay, so someone just gave me a great hint to say use the view on the taskbar, and then I can have two windows open at the same time. I have to admit, I'm usually reviewing spreadsheets, not building them these days, but great advice for those of you who are building them. Cash flow projections. You've got to know your cash flow. Now, I've got to warn you, as I'm an accountant, putting together a true cash flow projection is the most complicated accounting activity, bar none. And the problem with it is that the number that makes all the item that makes all the formulas work is cash. So if you have any error in any of your formulas, your balance sheet will balance because cash is a plug to make it balance. But since cash is what you're trying to figure out, if you make something a minus sign rather than a plus sign, you're going to think, oh, we don't need to raise money for 3 years, when in fact you need to raise money in 6 months. So it's a very complicated. So I've come up with what I call a simple cash flow projection. And all we're doing is we're looking at your revenue, okay, your revenue from your quarterly P&L, but we delay it by a quarter because customers don't always pay on time. In fact, they never pay on time. But a 90-day receivable, you should be able to collect your receivables in 90 days. But all of your other expenses, your employees want to get paid this month, this quarter, not next quarter. Your suppliers want to get paid this quarter, not next quarter. You might have some capital expenses. And so there's only 2 things that get plugged in on this simple cash flow formula. Well, there's 2 things. One is you get to determine how much money you raise and when. That's not, this is your magic wand time, okay? I'm going to raise $5 million and here's how we're going to spend it, okay? And here's where we're going to need more money and here's how much money I think we're going to raise. The other thing on here is how much money you're going to need in capital equipment. So are you going to need to buy computers for people? Are you going to need to buy prototype equipment? Are you building an electric car? You're going to need to buy hoists and winches and forklifts and all the products that go into a car. So this just tells you how much cash you're going to need. And all I would say to you is when you're presenting these models to potential investors, never let your ending balance be 0. Now, you may not be able to raise the 12 million bucks, but never let that ending balance go to 0. Always assume that you got to be the optimistic entrepreneur. You're always feel like you're going to be able to raise the money that you're going to need to keep you out of 0 or negative cash. Okay. Let's look real quickly at a couple of companies in the retail space. Not very good gross margins. They don't spend anything on R&D. The operating profits are not particularly great. And one of the things that I think you should track as you put together your spreadsheet that I've tracked here on these companies is revenue per employee. So 181,000. So basically between 150 and 200,000 in revenue for a retail employee. Let's look at fast food. Again, not very good gross margins, except for Starbucks. No R&D. Notice much more advertising here for Starbucks. Probably less efficiency of their place, less volume on their drive-through. But McDonald's has a better operating profit than Starbucks. Look at the revenue per employee here, under $100,000. Let's look at some tech hardware companies. Now, these are kind of the companies that I was used to. Good to great gross margins, with the exception of Dell, which is kind of more of supply chain, more of an assembly place. They're not adding a tremendous amount of value, but they have tremendous efficiency and tremendous volume. So an operating profit of 6% on 57 billion ends up being a good number. Look at the revenue per employee from these companies, 300,000 up to about 600,000. Okay. Let's look at some software companies. As I mentioned, Microsoft has only an 81% gross margin. Now we're starting to see R&D. Let's go back to the last page. Now we see R&D is in kind of the 10 to 15%, except for Dell doesn't add a lot of R&D value. Let's look at these companies again. R&D in the 10 to 15% range. My feeling is your R&D ought to be 10 to 15%. 15% is a pretty good number for a smaller company. Even 20% is not crazy. Great operating profits here. Revenue per employee 300,000 to 650,000. Okay. Some internet companies. When I first did this presentation, I said Google is at 1.1 million in revenue per employee. I said, they're growing like crazy. They can't keep this up. I went back and checked the numbers recently. They've doubled their employees. They've doubled their revenue, and their revenue per employee actually went up to, I think it's 1.2 or 1.3. Don't quote me on that, but it's definitely more, which shows what a unique company they are. I wish I could get a raise of hands to see what you guys think the average Google employee makes, but I'll tell you it's $256,000. So don't delegate building your financial plan. Don't outsource it. Don't hire someone else. You do it. You get together with the rest of your management team. Maybe someone needs to take the lead, but you need everyone on there. Generate sales projections from the bottom up, and absolutely don't do best case, worst case. There's spreadsheet fatigue. You put together what you think is the best argument you can make to succeed. So just put together just one set of numbers, no best case, worst case. Okay. Ways you put together show steady, consistent growth. Put in the percentages next to your columns, because those are really important metrics for how your business is doing. Maybe more important than the actual numbers in the revenue and expense side. Do not show post-tax. Do not show net operating loss carry forwards. Everyone knows eventually you're going to have to pay taxes. That's a happy day because it means you've finally eaten up all your losses. G&A expenses, don't allocate them. Don't depreciate stuff. Just treat it as a CapEx and take it out of your CapEx, and remove your color coding and all. I have some rules of thumb. You may have a great business with 2 or 3 buddies. You can grow this company to 5 million in revenue. You have maybe $1 million or $2 million in expenses. Maybe you have 3 million expenses. There's 3 of you splitting $2 million in profit. You just go, we could keep this thing going forever. We're not working too hard. Take your $600,000 and say, man, this is better than working at Google. Okay. But you grow a business to $5 million and it stays at $5 million. It has no interest to an investor. So when I give you these rules of thumb, I'm helping you put together a business plan that is interesting to investors and most relevant for a technology company. We've talked about your product. We didn't talk about distribution strategy, but think about how you're going to sell your product. Here's the important thing: is get that R&D between 10 and 20%, G&A between 5 and 15%, and operating profit, I'd say, look, somewhere between 10 and 20%. You got to get to a profit. Okay. I would grow your revenue to $50 million. Maybe you could get by with 40, but if it's 20 million in 5 years, I just think it's not going to be attractive enough to investors. And Julianne talked about what investors are looking for. They're not going to be able to get the returns they want if you don't grow to 50 million. Revenue per employee, as I said, track it. If it gets over $500,000, add more people. Revenue per salesperson, between $1 million and $3 million. I often see people growing their revenue way too high. I often hear people say these are very conservative numbers. Never use the word conservative when you're talking about your business plan. Okay, because it's overused, and I 99 out of 100 people who say these are very conservative numbers miss their numbers. And your operating profit, I know you're thinking I'm saying that it's going to be hard to get to 10%. I will argue you will find it hard to keep it below 25%. Let me just show you, there's the top 50 tech companies, and let me just show you, this is revenue per employee. And if we take out these two outliers here of Netflix and Facebook, look at this. They're all in the kind of 200,000 to $1 million, with, I'd say, kind of the sweet spot is $500,000-$600,000. So don't think your company, I mean, look at these companies. This is a great list of companies. You'd love to be included in here. And these are big companies. So if they can't have more than $500,000 in revenue per employee, why do you think you can? And then let's look at operating profit. Again, I just pulled off a dozen companies here. And Microsoft and Facebook are over 34%, but everyone else is kind of in the 20, a couple in the 20% here. Look at Google, 21%. And look at the rest of these. You're below 10%. So don't let your operating profit get too high. It will strain your credibility if you say, I'm going to have a 25% operating profit. And believe me, I've seen business plans where people say, oh, this conservative number, we're going to be at a 45% operating profit. Staffing is going to drive your expenses. We've added in the benefits. Salaries are going to be 66% of your total expenses. Just trust me on that. I've looked at, I can't tell how many companies I've looked at. I called the CFO. I said, hey, do me a favor. Just tell me how much your salaries are, your total expenses, whether they're 5 million, 10 million, 25 million. Salaries are about 66% of your expenses for a tech company without a lot of excluding cost of goods sold. So if you do raise money, your investors don't want you to starve. Pay yourself a kind of a living wage. Pay yourself what you could get if you went out and got a real job. Don't assume you're going to go to Google though, because they do want you to be hungry, right? They don't want you to say, hey, I'm comfortable with this salary that I'm giving. And the reality is you'd rather pay yourself less and have to raise less money and take less dilution, because the real payday is on your equity. And if I don't hurry up, we're not going to get there. So don't want to spend your own money, but they do want you to spend the money like it was your own, okay? So let's talk about equity. Investors they need to put a lot of money in these days. They've got huge funds, $500, $800 billion funds. So they've got to put in $5 million. They don't have the bandwidth to put in 500,000 unless there's the credible opportunity to put in 5 and 5 or 10 after that. They want a significant ownership. So even if they put in 5 million, they don't want to own 5%, because no matter how successful you are, they're not getting a big enough return. Now, and they are targeting 4 times absolute returns in 7 years. So let's go through the formula. The venture percentage that they get is the amount that they invest divided by the pre-money valuation plus the amount that they invested. So notice that number's in there twice. And this is the wild card here. What is the pre-money valuation? We don't know. It's a negotiating point, but it's how it's done. So you need to understand this formula cold. Okay, so here's an example. They put in 4 million on a 6 million pre. So their percentage ownership is 4 million divided by 6 million pre plus 4 million invested is 4 divided by 10 is 40%. So let's say you have 2 rounds of funding, okay? In round A, they put in 5 million on a 5 pre, they get 50%. In round B, they put in 10 million on a 15 pre, so that would be 10 divided by 25, they get 40%. But recognize they don't own 90% of your company, because the Series A investors get diluted just like everyone else by 40%. So that 50% gets diluted down to 30%. I have a spreadsheet that explains it if your head is starting to explode. So in this case, the VC has invested $15 million and owns 70% of the company, and they're targeting a return of 4x. So the company needs to get to a 108 million valuation for them to get the return that they're hoping to get. So you've got to show how you're going to get to $108 million valuation. I always argue, don't put that page in your pitch deck about exit scenarios and how much you're going to be worth and discounted cash flow and any of that BS, okay? Just grow a company to $50 million. There's plenty of exit scenarios out there, whether it be IPO, whether it be acquisition, whether it be put more money in and grow, keep growing it like crazy. That if you can get to that happy place, believe me, investors know that there will be a happy outcome for them. Okay, so but that's why your revenue needs to get to 50 million if they're investing 15 million, because they've got to get that return on their money. Here's the spreadsheet that we're talking about. Okay. A couple of things we've added here is we've added an option plan for future employees. Let's do this. Where the founder started with $4 million, 4 million shares, they owned 100% of the company. We then brought in key employees and advisors, and the total shares went from 4 million to 4.5 million. The founders got diluted to 88%. We then brought in our first round of angel money, 500,000 at a 4.5 pre. The angels got 10%, so enough share, whatever shares they need to get them to 10% is how the formula works. And everyone got diluted by that 10%. So notice our founders still have 4 million shares, but since we're now up to 5 million shares total, they're down to 80%. We then brought in our first angel VC investors, 5 on 5, as I mentioned. They got 50%, but they're also going to require that you create an option pool. In this case, I made it 12.2% because the round to make everything nice and round. You're now up to 13 million shares. The founders are down to 30%. And then the next round of funding comes in at 10 at 15 for 40%. Again, another round of dilution. The founders are down to 18%. Is this bad? Is it good? I don't know. You tell me. If with $15 million helps you grow a $100 million company that has a $300 million market cap, let's call it 500 million in these crazy valuation times, 18% of that is $90 million. I don't know. It's probably worth it, right? So let's look at this. Let's look at the detailed spreadsheet. I would just say, look at this page here. Just the key thing is the work to be completed is always greater than the work that has been completed. So don't necessarily reward people for what they did for me yesterday. Put them on a plan based on what they are going to contribute in the future, because you're going to be relying more and more on your team the bigger you get. And I think everyone should invest, including the founders. So think of this as a situation. There's 3 of you. Everyone's gung-ho. You're a third. And then after 1 year, one founder, times are getting tough. You haven't been able to raise any money. No one's getting salaried. One guy gets a job offer from Google and he leaves, and he takes a third. She takes a third of their stock, and because they're not vesting, they get to keep it. And the 2 of you are sitting there working your tail off, and this person has the same amount of stock as you. I know going in, everyone says, "Oh no, we're here, we're committed for the long run." But trust me, this is a worthwhile to do. Is it realistic to keep 51% of the company with venture capital? My attitude is, founders who are so worried about owning 51% of their company rarely succeed, because they're thinking about the wrong thing. They're thinking about how much of the pizza they own instead of how big the slice of pie that they own is. Ownership. This is just some guidelines on what you'd like to see ownership after 2 rounds. This is primarily for hired guns. So if you brought in a CEO, you'd expect them to have 5%. Founding managers might get 2 to 3 times this. Founding employees, especially like programmers, that kind of thing, might get 5 to 10x these numbers, especially like 0.1. You might give a key early employee programmer, you might give them a 0.5%, knowing that they're going to get diluted down. Okay, so this is the spreadsheet, just like my income spreadsheet. I always start at the end and say, if I don't like this, then let's make changes early on. And so you say here, if we ended up with 18%, and this was the founder split, 9, 4.5, 4.5. If you're this founder and you think you deserve more than 2x the other people, the time to negotiate it is here. It's too late. Once you get on this path, it's too late to do it. Likewise, for your other employees, when think about a happy outcome. Is it 100 million? You say, we sold the company for 100 million. We worked on this for 5 years. As the CEO, I got 9.1 million, and my other 2 founders got 4.5. Does that seem fair? Does it? When you start thinking about real numbers, it helps shape your opinion. And so this spreadsheet is out there, and let me just show you. Just work on the yellow. Just enter the yellow fields. Don't enter anything else, and this will show you everything that's going to happen in your company. Okay, so this spreadsheet will be out there, and I will stop sharing. And we've got a few minutes for questions, unless Joe wants to take care of some business.
No, I think we're good. Take any questions, Charlie.
Okay. Should you put your IP in your personal name or in the company name? Your investors are going to mandate that it belongs to the company, because what they don't want you to do is either leave the company and take the IP and start a new company, or else hold the company hostage for use of the IP. So you are the company. The company is you. The IP comes with the company. What kinds of multiples? I would say 5 on 5 is very low in today's environment. So it all depends on what you've got, where you are in the process. As long as you've got something that you bootstrap that you can show people, is it 5 on 10? But it all depends. I mean, I could spend an hour talking about how to orchestrate that process. The whole goal of the VC fundraising process is to get two term sheets within 2 weeks of each other, and how you speed someone up and slow someone down so that they get there at the same time is critical, because term sheets start to get stale. And if you haven't accepted in a month, you've got a month at most to either accept it, or they're going to say, we're not feeling the love. You know what? We're taking our term sheet back. How can you guarantee you don't get laid off from your own company? In the words of Bill Belichick, do your job. Okay. I mean, look, I hear a lot of founders. There are a lot of founders. Oh, I got screwed by my venture capitalist. There's often more to the story, and I mean, I'm not saying I'm not sympathetic to that, and I'm sure there's some people on this who've had bad experiences. I just, don't be too worried about 51%, and don't be too worried about now. If you're a founding CEO, I think you might need to be open to hiring a CEO and you transition to a CTO or a biz dev or some other role. But that's that. Anything else? Any hands raised? Okay, I think that's it. I think I got most of the questions that are at least in the second half of the page, and I haven't scrolled up. So it's been a great working with. Don't forget, go and write those 10 and 25-year goals down, okay? Because your brain will keep processing it, and who knows what you'll accomplish in the next 25 years.
Charlie, we actually have one question before you jump.
Okay.
Sophie and John.
Hi, how you doing? Just one last thing. I know you glossed over a little bit about like the dilution with the investment, but like I've seen a couple of metrics on how you can get your company's valuation if you don't have any product, you don't really have any, you just like a couple of people with ideas and some like MVPs. How, like, I don't know, is there a good method for getting that valuation, and how strong are those methods based to reality?
Yeah, so there are websites now that will allow you to look at, I forget, someone here will know it. It's the there's Deal Tracker or something, but there's some websites that are out there tracking VC investments that will show you investments that got made and at what valuation, and so that's one place you could look. And
Like
just ask around. It's a little bit harder to network these days, but you've got to find you've just got to ask around and see what other companies are getting. So but there really isn't. I mean, there's yardsticks, but there's no real formula.
Okay. Thanks.
Revenue per employee would be only paid employees, right? So if you have volunteers, yeah, that's great. More power to you. So, all right. Thank you very much. It's been great seeing you. Hopefully next year we're back live in 10-250. And good luck on my email address is on my presentation. If you've got a quick question or you've got your 4-year projection and you just want someone to give it a once over, I'm happy to look at stuff and give you some feedback. So feel free to reach out.
Okay, well, thank you very much, Charlie. And hence, everybody claps. And the recording and Charlie's slides will be on the website by tomorrow afternoon after we get them all edited and everything. So thanks once again, Charlie, and I hope next year you get to do heli skiing like you like.
I know, I'm banned from Canada like all Americans.
Okay. All right, good night all.